This is Kali Persall, editor of Institutional Investing in Infrastructure, and I am joined today by Nick Cleary of Vantage Infrastructure to talk about opportunities in the U.S. middle market for infrastructure debt. So, Nick, great to have you here as always. Can you just kick us off with a brief introduction of yourself and your role at Vantage?
Yes, certainly. Thanks, Kali, for having me on today. So I'm Nick Cleary. I'm one of the two senior partners in the Vantage business, responsible for our North American business. In short, we're a platform that's been around for many years now. I'm very focused on infrastructure credit, investing broadly globally, but quite focused on a couple of the niches where we see sort of pretty compelling value globally. And the US middle market that we're talking about today is one of those.
Great, thank you. So I understand the infrastructure debt market varies depending on the region you're in. What makes the United States different to other markets for infrastructure debt?
So in short, infrastructure in the US is at a lot earlier stage. And that comes with some challenges, but also comes with some opportunities that there's generally less competition from a less mature market. And I think there's sort of more white space to find value than we see in some of the more mature and more competitive infrastructure markets. But what's more fundamental and what's more enduring about the difference of the US is sort of a combination of a couple of factors, one that's general and one that's relevant to infrastructure debt. The general one is the US is really quite highly fragmented by a range of local, state and government approaches to infrastructure. And then for infrastructure credit, it's sort of the role of the capital markets and sort of finding these lanes where the capital markets has the lead and banks are competitive, but finding those opportunities in between those lanes that create value and opportunity for a credit lender and help sort of progress the growth of the US market by providing a different type of financing. And I think the path we see, like if we look at other markets, infrastructure has probably been led by the top-down federal government approaches to infrastructure, and that sort of brought certainly a level of government support and stability, but it's also brought a strong level of standardization to the infrastructure market, where in the path the US has taken, it's very much relied on government retaining ownership of core infrastructure stock, particularly core infrastructure in transport and utilities. And that's also been enabled by the capital markets because the financing tool for that has been the municipal bond market, which is a relatively unique tax advantage bond market for government-backed infrastructure in the US. So the US has held on to a lot of its infrastructure in the public or government ownership, and that's really limited the role for the private sector to be quite small. And it's been mostly in the past focused on power and energy, and that's why if you look back 10 years ago, US or North American private infrastructure was the third largest infrastructure market globally, behind Europe and behind Asia Pacific, which was quite odd for such a large economy. And that's a little bit why we're spending a bit of time talking about the US, because in the last 5 years, the US has gone from about the third largest market to the largest market globally. It's regularly issuing around $500 billion of debt each year, and the growth rate we've seen of that in the US, say, relative to Europe, which is probably the other core infrastructure market globally, the growth rate of debt getting issued in the US is about twice that we're seeing in Europe. So, we're certainly talking a lot about the US at the moment, and I think we'll be talking a lot more about it in the future, because what this means is I think the US is the new kid on the infrastructure block. It's a little bit different to some of the other markets. And that's quite exciting as it's opening up more opportunities and different, and probably equally importantly, different opportunities for investors who are looking to grow and diversify and probably uncover better value in their private market portfolios. So US infrastructure is playing quite nicely into that need for investors.
Yeah, so expanding on that thought a little bit, how is strong US investment growth offering investors more choice and opportunity?
The greater choice and opportunity for investors is really rooted in the fragmentation of the US market. It's embedded in this history that US infrastructure always been sort of owned very locally. It's been a local responsibility. It's not been driven by top-down national government incentives or policy or regulation of pricing or coordination like we've seen in other markets. Instead, the US has relied to a lot greater degree on local market demand, and a lesser degree on national government-backed regulation or revenue support. And so what I think that really means is that governments focus more on the larger core projects, and the private sector, there's a greater opportunity for the private sector in the smaller and this more fragmented market. We also see in the US that aspects of permitting and approvals add another really important layer of probably fragmentation. I think the result for the investment community is still generally a positive one, because some of this fragmentation is limiting competition. So that fragmentation does create better value, but probably more importantly, this sort of different type of infrastructure and different type of approach to infrastructure we're seeing in the US is offering investors something different to what they find in other regions. And one of the examples I like to use on this is solar or solar power generation. So the standard way to invest in solar power generation globally is sort of a utility scale model. One project, one off-taker, a large project. They're pretty standard globally. While in the US, there is also utility scale solar, but sitting alongside that, there's also a very established community solar and residential solar industry. And now we're also seeing in the US solar module manufacturing projects that are getting developed to support the local content requirements of US generation projects. I think that's a really good example of, in the US, here's a concept of let's invest in solar generation, but there's actually now 4 very different distinct subsets of how to access that. There's a very similar sort of theme of fragmentation, I think, across a lot of other sectors where the US is sort of not just going down one single model of how to develop a sector. That does create complexity, but it creates a good level of diversity for investors.
Yeah, so you highlighted the complexity and fragmentation in the US market. How is a lack of suitable traditional debt lending creating opportunities in the US middle market for infrastructure debt?
So I think the fragmentation we were just discussing, as well as a bit of the scale and the complexity that comes with middle market, really doesn't fit well into the muni bond, 144A, public bond, USPP, ABS, or term loan B market. So, if you're not familiar with the US, you'll have to excuse the heavy use of acronyms. But in short, really what all that means is the US has a range of very efficient and competitive capital markets, both across investment grade and sub-investment grade. But what those markets really require to sort of work in favour of a borrower is certainly a minimum scale and some sort of standardisation of structure. And often those requisites are not a great match for middle market. These are often projects that are growing into that market, but are not there yet. And what's also, again, this is maybe one of the unique aspects of the US, that where those gaps are to middle markets, in other markets, banks usually fill that gap. And particularly for infrastructure, banks are still a sort of a stalwart of lending to infrastructure, which is a bit different to the corporate middle market lending where they've pulled back. The banks in the US do less gap filling. They're not looking to hold assets on their balance sheet. Instead, the US is very focused around bridging and either a period of M&A or construction into the capital markets. When you look at percentage of bank loan lending, in Europe, European corporates are funded about 70% by bank loans. In the US, that's 20%. And this is sort of why we have this, I think, somewhat odd situation in the US, that with such a strong banking and capital markets, there can be a lack of financing for certain types of infrastructure projects. And that's sort of what underpins this as the US is growing. The capital markets and the financing solutions are catching up. Effectively, the US growth of infrastructure has grown faster than the banking and capital markets can adapt. And that's what's opened up a great opportunity for investors to sort of fill that gap, and that gap is most often sort of in these middle market transactions, which might be, at the very small end, $50 to $100 million. At the larger end, maybe 200, maybe 300 to 400 million before they sort of hit a scale level that work for banks and the capital markets.
So sort of rounding this out, in what ways do scale and complexity come together to drive value in US middle market infrastructure debt?
Scale and complexity have probably been one of the pillars we've seen consistently over the last decade, of one of the drivers of where we find sort of some of the more compelling value in infrastructure. And it's relatively straightforward. A large standardized financing will attract more lenders, have more financing alternatives, we'll see more competition. And that leads to pressure and competition on terms and competition on price. While a smaller, complex, less competitive situation sees less of all of those things, that generally means better terms and better pricing. So it's a pretty simple answer, but the practically it's not that simple, because complexity requires experience. It requires, I guess, experience and sometimes patience and time to work through the details, to sort of work out if that complexity can be understood, structured and mitigated, or if it's just simply a complexity you don't like or you don't understand, and it's just best avoided than the transaction passed. And I think scale also adds some complexity, but that's more related to the size of the lender, because it takes a relatively fixed amount of time to do a transaction. So it doesn't matter whether it's small or large, it's going to take the same amount of time. And as the market has grown, that's certainly created opportunities for many lenders to focus on very large transactions that might, for banks, generate large fees, or for some of the larger corporatized asset managers to put large checks to work so they can do more with that same time. And that's a bit of a consequence as the market's grown, and that certainly caused people to sort of focus on the larger transactions. It's creating a bit of more of a challenge for the middle market space, because as there are more larger opportunities, some of these smaller opportunities again see less lending competition. So we sort of like to think, this scale and complexity is certainly a great opportunity for investors, but also trying to find ways where we can be constructive to the overall infrastructure industry by providing a different type of capital that's better suited to a certain type of project, to sort of continue and accelerate the growth that we're seeing in the US market today, and expected to see continue for many years now to come.